It's about a year since we had the last event, and since then the exposure draft on the lease accounting changes has come out. And so our agenda today is to walk you through those changes, what the exposure draft means for corporates.
Why do we have a lease project? Well, we've been talking about leases for a long time, and actually, as you may know, this is a joint project between the FASB and the ISB. So, more or less, we're converged actually on the proposals for US GAAP preparers and for IFRS preparers. The differences relate to the other different accounting standards that we have. Accounting has two types of classifications. We have operating leases and we have finance capital leases. And because of these classifications, the accounting doesn't always meet users' needs. When we issued the discussion paper, we had published a discussion paper in March of 2009. And in response to the discussion paper, some preparers said they were concerned about the burden of applying these standards for shorter-term leases. And so the boards went back and have included some simplified accounting for shorter-term leases.
If you carry investment property and you carry that investment property at fair value under IAS 40, then you are outside the scope of these lessor accounting requirements. If, however, you have an asset that does not meet the definition of investment property, or you carry that investment property on a cost basis, then these new requirements for lessors would potentially apply to you. Now, the lessor accounting requirements are to mirror the lessee accounting requirements in that you're looking at a right of use. And what you're doing is you're recognising, as a lessor, a right to receive lease payments in return for transferring that right of use to the lessee. There are significant changes to the disclosure requirements for leases under the proposals in the exposure draft. What we're trying to do with the disclosures is to identify and explain the amounts that are presented in the financial statements from lease.
Really three key drivers which impact the financial implications. One is the term, one is the rental growth that you're assuming. Contingent rentals, you have to build it into your calculation, and also the discount rate, whether that's the interest rate inherent in the lease or the incremental borrowing rate. One of the commercial implications of this is, will there be a general move to ownership? The view being, if it's going to be on your balance sheet anyway, why not own it? And obviously there are various factors which affect that, which we can come on to. This will force corporates to really understand the true reasons for leasing in the first place. And a general review of leasing policy is
the discount rate to use, I think, is going to be a major area. You can see from Richard's examples, the discount rate you use makes a big difference to the numbers you put into your P&L and into your balance sheet. I would think the earlier you start talking to your finance teams about what that rate is going to be and how you're going to agree that with your auditors, it'll make a big difference to the gross numbers. And if you are in financial services, as I am, my understanding is these assets arrive on the balance sheet just like any other asset and they're treated the same. So whatever your regulatory capital requirement is on owned assets will be the same. So that is a significant change. I would urge you, because if you don't go talk to your finance people now, in a little while they'll come to you in a panic. So I would suggest you go talk to them if they haven't started coming and talking to you. And importantly, your business colleagues, because you cannot do this exercise as a desktop exercise. What is on your lease register doesn't give you the information to do it.
Yes, I think we're assuming, we're believing here a lot of the drafting is around leases other than property leases, but here in the UK.
What impact will this have on Barclays and how are you preparing for it?
For Barclays, this is going to involve quite a lot of work in understanding what our portfolio is and what our true commitment is, and in particularly how that will need to be implemented across a multi-geography, multi-business corporation.
Clearly a lot of work to do there. A lot of the large, in square footage occupiers, but relatively small numbers of units will not have this on their horizon. It's really something we have to bring to their attention very quickly.
I think there's an awful lot of work that has to be undertaken. What's clear is that this will specifically put property plans at the heart of agreeing with the business and creating a greater dimension.
How are you advising your clients with the proposed changes, and what should they be thinking about in order to prepare?
I think probably it's still in 3 areas. One is understanding what the implications are, planning for the changes, and then working out how to implement them. There are probably 3 areas which are really impacting. One is the impact on the financial statements and the accounts. One is understanding the administrative burden and how you manage that, track it and report it. And the third one is how they change the real estate strategy. It's looking at whether they should be owning or leasing, what terms they should be signing up to, and how to just take leases on going forward.
We appreciate the opportunity to come to speak. We think that the questions are questions that are important questions that companies need to consider, the board also needs to consider, and we think it's a good opportunity for companies to come to get the information on proposals early enough that they can start talking to their advisors and their accounting firms and start the process of determining how the proposals will affect them.
And I think we found it an extremely useful event, getting feedback from the property perspective of what the proposals will mean. And I hope we've actually helped to educate people about the very significant changes that are potentially coming to lease accounting, so that they can get involved in the debate and hopefully provide us with more feedback as we move towards a final standard.
Today's event really illustrated the interest that there is in the whole corporate real estate community about this issue. It's probably the biggest single challenge that has faced the whole corporate real estate industry, certainly in my career. And it's daunting because of the changes that are involved, the administrative burden, the balance sheet and P&L impacts. But at the same time, I think it's an opportunity for corporate real estate to really take centre stage and actually make connections with the boardroom, with finance, with treasury, and take the lead in the strategies that are going to need to be developed to deal with the changes. Does it mean the death of sale and leasebacks? Should you be re-gearing leases? Should you be owning rather than leasing? These are the key questions that I think all corporates should be asking themselves.